Welcome to Willis Weighs In, where we discuss controversial and newsworthy tax topics. I'm Ben Willis, contributing editor with Tax Notes. Today, I'm delighted to be talking with Jed Bodger. He and I co-authored an article in Tax Notes in September, focusing on the administration's hopes for taxing wealth transfers. Jed, thank you so much for joining me today. How are you?
Ben, I'm doing fantastic. Thank you for having me. It is always a pleasure to see you and to engage with you. You've been one of my best friends in this realm for a long time, so it is absolutely my honor to be here with you today. How are you?
I am doing great. I'm so happy to chat with you. I know we'll do our best to try to keep our long-winded tax spiels to ourselves, but I think we got a really hot topic for a lot of folks interested in realization. And today we're going to be focusing on realization at death. I know our article, Taxing Wealth Transfers, got some attention, and hopefully this we can answer some of the questions that folks have been focused on recently. So with that said, let's go ahead and dive into one of the more pressing questions, which is tax legislation this year. I'm curious, what are your thoughts on the odds of some sizable tax provisions getting inserted into law this year?
So like a true tax attorney, I'm going to tell you, it depends. I'm going to hedge. I think it gets passed. I think there is a very good likelihood that tax legislation passes in 2021. I think the real question becomes how much of the Biden administration agenda is included. And this is one that, as you mentioned, has become a very hot button issue of late, and is one that has fairness components, it has equity components, it has revenue raising components, it has all of the components that typically make for sound legislation. But it also has an impact to individuals. And I think that is where this one potentially runs into a little bit of a hurdle. I think ultimately it gets passed, but I think it will be very tight considering the margins in the House and the Senate that the Democrats currently hold, considering how close we're getting to the 2022 election cycle and how contentious I believe that election cycle will be. I would like to say I think this is going to pass. I believe that this should pass. I just don't know that it in fact will. What do you think?
I think that we're going to have some major tax reform this year for certain. And I think to your point, whether or not we're going to have full agreement across the board for this reconciliation bill that we're looking at is questionable. And it's clear that there's a lot of lobbying going on. We're focused on Section 1014 of the code and whether or not we're going to have the elimination of a tax-free basis step up, and which is really one of the most frequently cited provisions for expanding the wealth gap, and one of the ways that the Biden administration has proposed to fix some of the inequalities in our code. So with that said, let me put a question to you. As far as inequality and creating a fairer tax code, do you think eliminating that basis step up at death and causing a realization event would create more equity in the code?
I do. I personally do. And the reason for that is because the utilization of what's commonly referred to as the lock-in effect has allowed for generational wealth to transfer many times over without the application of tax to the built-in gain. The lock-in effect is effectively the holding of assets that have substantial appreciation or built-in gain until and through death, and transferring via some sort of testamentary transfer, trust transfer at death, in order to achieve a step up in basis and elimination of that built-in gain. This eviscerates dollars from the U.S. tax net every year, and that in and of itself, and the ability for people with built-in gain assets to achieve the step up in basis is, I think, a substantial contributor to the wealth gap. I guess one of the questions that I would push back to you as we're getting into this, and when you think about 1014 and its repeal is if you had to choose between fairness on one hand and revenue raising on the other hand, if you were designing this legislation, is one or the other more important to you? Is there a way to achieve both? Are they both goals that we should be looking at, or are neither goals that we should be looking at?
That's a good question. I can't help but think, given that this is a reconciliation bill and has more revenue constraints than traditional bipartisan legislation, as the Tax Cuts and Jobs Act did, it's certainly revenue raising as a focus, and reinvestment in some of the high priorities of this current administration and those on the Hill and infrastructure are key. At the same time, I know that there's a huge focus on creating a fairer tax code and eliminating some inequities. And so I would argue that you're actually accomplishing both goals through the elimination of the tax-free basis step up that folks are getting currently, and eliminating that intergenerational tax-free transfer of wealth for those who are lucky enough to benefit from that provision. It will create more parity. Of course, there's a lot of examples that folks are focused on right now, namely family farms, and I think there are a lot of lobbyists are using that as the head of the spear to really focus on whether or not there's some inequities that could be created by this legislation, and some difficulties imposed on taxpayers. And so I'll do the same thing as you and put it back on you. As do you think that these family farms that folks are so focused on should prevent these goals from being realized?
So I think when we talk about tax legislation, we are inherently talking about the common good, right? The intention of tax is to provide revenue for the US fisc in order to run and operate at the most consistent and well-funded basis available. And so to the point of revenue raising that you just made, estimates are somewhere around the value of $40 billion a year that this would raise. So when you take that piece and keep it in perspective, when you look at the family farm consideration, I think the good outweighs the bad. Absolutely, there is a risk that there are non-liquid assets with significant built-in gain that would trigger a realization event in the event of elimination of 1014 at death that wouldn't be liquid and wouldn't be able to pay the tax. I think in a little bit, we'll talk about some mitigation strategies and some options for that. But right now, if we just focus on the illiquidity problem and the concern that these small farms have, and the issue that is being raised by the lobbyists and even some legislators regarding these small family farms, yes, there is absolutely a risk that some of these will need to be sold off in order to generate enough free cash flow to pay the tax due on realization. However, I think that is the exception, not the rule. That is such a minor portion of the amount of assets that have built-in gain that would be triggered by these provisions, that to utilize them as the rationale for not approving such changes would be the exception that swallows the rule. And in light of tax policy and the rationale for tax policy as being a benefit to the greater good, I think in this instance, the greater good outweighs these potential limited exceptions for difficulty. But it is a difficulty potentially to some taxpayers. Would you agree with that?
Yeah, I think it could impose some difficulty, but at the same time, and I don't want to jump ahead because I'm curious to those points about mitigation that you focused on earlier. I also believe that this was part of Biden's agenda, which the country voted on, and I also think in just the polls and the general public seems to be intent on eliminating what they view as an inequity that largely benefits the wealthiest taxpayers. Obviously, we know that the Tax Cuts and Jobs Act doubled the estate tax exclusion up to from 5 to 10 million. And there was a big benefit there for those who are passing along these massive estates. And so we're kind of left with this whole realization principle and whether or not that can eliminate some of the disparity. I think there's going to be challenges that are continuously being raised, and whether or not fairness and, as you said, the upcoming elections are going to be taken into account. But just from a pure technical standpoint, I'm curious as to your thoughts on realization of death at death and the burden being placed on the decedent. Do you think that's fundamentally fair and consistent with tax principles?
I do, and I do for a number of reasons. Primarily because the decedent is the individual that held the asset. The decedent is the individual that experienced the appreciation in value, the accession to wealth, almost, if you will. And granted, there's no realization event while they're alive, but there is one in their hands due to their death, unfortunately. I think if you were to think about it in reverse and say, how would you move the realization event onto the beneficiary? That is where I think I've got a little bit of a conceptual issue and a conceptual problem with things like a carryover basis, right? If you were to eliminate the step up in basis and leave the basis as is in a carryover situation to the beneficiary, now that accession to wealth has been moved into the beneficiary's hand, and they will be required to effectively trigger gain and pay the tax on their disposition for an asset that they either potentially didn't originally acquire, and now all of a sudden they are burdened with the tax cost. Similarly, currently with the step up in basis, a decedent receives an asset that is fully based up to the fair market value of the asset they receive. If you trigger gain at death, the decedent or the estate will pay the tax on the asset, which would fully basis the asset up to the fair market value. So the beneficiary would receive effectively the exact same thing that they receive now, except you would not have eliminated this significant amount of built-in gain in the tax system. That's where I think you come into the discussions of equity and fairness. You eliminate the lock-in effect. You eliminate some of the significant transfers of wealth. You eliminate some of those concerns that you and I have talked about. And so because of that, I personally believe that the right place to levy the realization and recognition event is at death on the decedent in the estate, not on the beneficiary. Is that how you think about this as well?
Yeah, I like the way you described it. It's almost a continuation of the ownership of property, or you're thinking about it as it transitions. And so you've got the decedent on one hand and the beneficiary on the other. And when the decedent passes, a carryover basis over to the beneficiary would cause that burden related to the built-in gain on that asset to shift over to the beneficiary. And I can't help but think that's likely where this came up in our code, which is, who do we place the burden of this gain on? Are we going to put it on the children and the wife who receive it, or the children, because we know that married get this benefit of generally, but were we going to put it on these beneficiaries to pick up that gain when they sell? And I can't help but think of the principle that often comes up, and you and I know this as corporate tax practitioners for the majority of our careers, that when property's leaving the U.S. tax net, whether outside of a corporation or through a partnership, generally there's this last clear chance to tax them before it leaves U.S. taxing, and there's that analogy to death, which is that this individual like you said, had benefited from the appreciation during their life, and now it's getting passed on, leaving one ability. And if they don't get that basis step up, which is right now a complete giveaway as far as eliminating tax from the income tax system, then it's gonna get imposed on the beneficiary if the basis step up is removed. And so I think the taxpayer, the decedent, is indeed the last clear chance to tax that asset when the legal entitlements change as it shifts and transfer from one owner to another. And so I'm with you on that.
Yeah, I think the other piece to that is, as we've sort of touched on briefly before, is it eliminates that lock-in effect. It eliminates that wealth gap that this provision continues to exacerbate. And we have seen in the past however many years, 10, 20, 30, 40, 50 years, the wealth gap in America continue to expand. And I think there's a very clear correlation between the wealth gap in America and the ability to transfer assets with built-in gain without realization of that gain. If you think about it, anybody that's taking inherited assets has effectively received built-in gain tax-free, whereas the counterpart is starting from a diminished perspective, because every dollar that they earn is going to be subject to tax via the income tax system, because they were unable to start on a level up. Those two individuals, if you think about them going through their lives, running the exact same career, having the exact same amount of income, the person with the asset transfer via intestacy, right? The person that receives a testamentary transfer with a stepped up basis, at the end of their life will have an asset in excess of what the other person had. And that asset could have, should have, most likely will have appreciated in value for that entire period. So their ending points, while their starting points already started different, their ending points are even further apart, because now, due to that lock-in effect and due to that step up in basis, the person that received the transfer at death from a parent or some other relative now has the ability to hold on to that asset until death, receive step up in basis, transfer it to their children, and now their children, compared to just the straight income earner, are now even further apart than the first two were. So I believe that triggering this realization at death not just eliminates some of that lock-in effect, but would help to eliminate the continuing growth of the wealth gap in America. I personally think that's an issue. I don't want to speak for you. What do you think? Is that something that we should be concerned about while creating a tax code, while thinking about fairness and equity and revenue and generating taxes?
Well, I can't help but think about the last major reconciliation legislation that passed, and the major impetus behind so many of those tax provisions were economic frictions. And so we were trying to eliminate some of these economic frictions through that lockout effect. And that was where a lot of the pay force came from. And we were able to have our 965 mandatory repatriation tax that was to end the lockout effect from offshore earnings and encourage investment. It was hoped that trillions of dollars would flood into the US for that. And so it brings us back to this important lock-in effect that you're talking about, which is people holding on to property to get this potentially massive tax benefit. I mean, you could have founder shares. You came in early in Microsoft or Apple or one of these other companies, and now you're holding greatly appreciated stock. And the question is do you sell it and pay that tax on it, or do you choose other property and pass that along so it gets this massive tax-free benefit in this basis step up? I'll throw it to you as, do you think that this lock-in effect actually creates in reality for folks a true economic friction? Does it actually impact their decision as to whether or not they should freely sell assets or hold on to them?
Yes, I absolutely believe in it. I believe it is real. I believe that to the extent you have people that are nearing death, that are starting to engage in significant estate planning tactics, the clearest way to minimize your ETR within your total estate value, to the extent that you're under the threshold amount, holding assets till death is the absolute easiest way to do it. You've effectively created a negative ETR because you've got built-in gain that's taxed at zero, but realizes a full step up in basis. I believe it is real. I believe it's not just out there and something that we see sort of by example. I believe it is an actual technique that is utilized in order to say, okay, how do we deploy our unitary exclusion in the way that's most beneficial to reduce the total value in the estate? Oh, and then by the way, how do we utilize our step up in basis in order to ensure the most value transfer to decedents? So yes, I do believe it is out there. I believe it is real, and I believe it is utilized regularly.
So let's try to give some practical advice to Congress, a lofty goal, I know. If we're trying to eliminate economic frictions and create an economy where assets move more freely and there's less cost associated or holding in, and just like the lockout effect, then how could Congress address some of the concerns that folks are raising right now relating to, you know, farms? And I'll even expand on farms and say, there's other equitable areas that Congress is probably keeping their eye on, which is mission-based organizations, community reinvestment companies, that are coming from these startups oftentimes, and have families that the money is now new to them, and they're able to invest and grow, and not just in the farms. This is occurring in cities throughout the country. For these types of businesses where this could be an issue, the liquidity, the ability to pay for, oh, I might have to sell the family farm in order to cough up the money for this bill. Do you have any thoughts as to remedies? I know there's discussions about changing the exclusion, which was originally in the Green Book proposal, which we talked about in our article, or we made predictions about, some good ones, I think, for $1 million. Are there thoughts that you have as to how Congress can remedy some of these issues?
Absolutely. I think there are, from my perspective, two that if I was in Congress, I would be arguing for, in order to rebut the claims of the disparate effect on family farms and small businesses. Because you're right, it's not just family farms. It's going to be small businesses, S corps, things that are potentially high value businesses, but not necessarily significant cash driven businesses, meaning they wouldn't necessarily have the cash on hand to pay the tax on the appreciated gain. The two that come to mind immediately for me would be, one, to build in an election mechanism so that should you have an asset that is going to trigger a significant amount of gain at death, the beneficiaries or the estate really would have the ability to make an election to not trigger the tax immediately, but to transfer the asset via a carryover basis. In my mind, it's similar to the ability for a corporation to transfer assets to a subsidiary, and they have effectively the mechanism to make that determination via either a 351 tax-free contribution, or they can trigger tax on the gain in order to step up the basis in the assets that are transferred. Here, you could effectively do the same thing. If you have an election mechanism in place and you don't think you have the cash on hand to pay the tax, you can make the election to transfer the basis, to transfer the basis to the beneficiaries, and allow them to pick up that built-in gain burden when they're triggering a sale or some other realization event on the assets. That's one. I think the other way to do it is to recognize that you've got a cash payment obligation due to the realization. And at that point, you can put in, similar to the 965 transition tax that you had discussed earlier and touched on, you put in a deferral mechanism so that you have 5 years, 8 years, whatever time you get yourself on a payment plan. Say, hey, look, I can't dispose of the asset right now. I don't want to dispose of the asset, but I understand that there's a liability here and I will pay it over time. And I think in order to utilize these, because of the intention to protect people that are small business owners, small farm owners, I think you couple all of that with some sort of a value limitation, right? This shouldn't be the transfer of the largest S corporations in the world and the largest conglomerate family farms in the world, but rather this should be something that has a value limitation of 10, $50 million, something like that. Anything under that amount should have the opportunity to either elect into a carryover basis regime or potentially elect into a tax deferral mechanism that allows them to stretch the payments over. Those are the ones that come to my head. Would those convince you if you were on the other side of the aisle from me?
I think that would certainly help. I'm going to add one to your list too. I really like the idea of the election that you're talking about. I think that makes a lot of sense to me. I mean, earlier we were talking about the decedent and the beneficiary, the ultimate recipient of this property. And if that recipient, who historically I think Congress didn't want to put the burden on that we're talking about that relates to this built-in gain, if that decedent is willing to take that burden on, I can see a valid argument for saying, okay, in these instances, if there's a liquidity concern, if you're, a business under a $10 million threshold, we can see transferring a carryover basis to you. You make that election, and that provides some equity there. The second, I think the payment plan is certainly a good option. What I would do for a third option, which would be built into that, it was almost an alternative to your second one, would be to shift the burden to the IRS. And this isn't unprecedented. I know earlier we talked about carryover basis and property shifting outside the US and that last clear chance. Well, historically, under Section 367, the IRS had to come in and say, wait a second, we're looking at this transaction and we're seeing that the basis and the built-in gain is preserved in shares, and we're going to issue a PLR that says that we're signing off on this transaction. I think that's a possibility here. I think other guidance that the IRS could issue, whether it be through regulation or notices or procedures consistent with congressional intent for the IRS to approve in some instances, through confirmation that this gain will be picked up, there could be built in for those limited exceptions, whether it be a 10 or a $50 million threshold, a liquidity concern. And if certain, criteria are satisfied, then the IRS could sign off. I know some folks don't appreciate the IRS's involvement in here, but I do view it as a positive. In other words, building some flexibility into the code for practical aspects that I think could certainly arise. So I like that aspect there. Your thoughts on that?
I think your perspective is spot on. I think that it gives some plausible deniability to Democratic members in particular to say, hey, look, this isn't on us. We put a little bit of a framework out there, but it's really the IRS that has to address it, that has to interpret it, and that has to enforce it ultimately, which is the role of the IRS. So in that sense, I hear what you're saying. I think it makes sense. I think if I'm a Republican member, I am going to push harder for the optionality of carry forward of basis and higher thresholds for what triggers carry forward and potentially the deferral. Because at that point I can go back to my constituents and say, hey, look, this is the benefit I got you. It's this big, it's quantifiable. I did that, as opposed to leaving it in the hands of the IRS. So I think it makes sense. I think that they could all work very nicely together too. These don't feel to me like an either or situation. But I guess to close us out today, my question to you would be, how confident are you that any of this passes? Are you willing to make a 20 push-up bet with me right now as to whether or not this goes forward?
On realization at death, I'm 20 push-ups in. I'm betting it's happening. So I think ultimately there's too much on the line. Putting this in our liability and possibility of greater deficits is going to be too much of a concern. And I think this creates some equities that we've already talked about and eliminate some disparities. So I'm gonna say 20 push-ups is on. If it doesn't get passed, you'll see me doing them. How about you?
I agree. I hope that you are exactly right. But in order to take the other side of the bet, to make it a fair bet, if it doesn't go through, I'll do my 20 as well. But I absolutely hope you're right, because I think you are spot on with the analysis and the rationale for this. And I think it makes good tax policy sense. I think it makes good revenue generation sense. And for me, most importantly, I think it helps to make the fairness aspects and the intention of the Biden administration to bring some fairness and equity back to the tax code. I think this really helps to push that agenda forward.
Jed, as always, I love speaking with my old friend, and thank you so much for joining me today. I really appreciate it.
My absolute pleasure. Thanks for having me, and I can't wait to speak with you again.
For those of you watching and listening, thank you so much for joining us today. You can find my other videos, articles, and blog posts on taxnotes.com. Please don't hesitate to reach out with any questions or comments. You can email me at ben.willis@taxanalyst.org or find me on Twitter @WillisWeighsIn. Thanks. Want more like this? Subscribe for more tax videos. Special thanks to our executive producers Jasper Smith and Paige Jones, and showrunner and video editor Jordan Parrish.